All right, welcome to The Explainer. Today we're diving into a real market mystery, a puzzle that is even the pros scratching their heads. You see, stocks and gold are both hitting all-time highs at the same time. Now, that should not be happening. So what on earth is going on? Let's break it down.
Okay, so for basically half a century, the rule has been super simple. When stocks go up, it means people are confident, and gold, the ultimate safe haven asset, goes down. And when people get scared, they sell stocks and buy gold. They're like two ends of a seesaw. But right now, the seesaw is broken. Both ends are up in the air at once. This is a first, and it's a massive red flag that something fundamental in our financial system is, well, acting very, very strange.
So our first major clue comes from the precious metals market, which is absolutely roaring right now. But the more you look at it, the less it seems like a sensible investment, and the more it starts to look like a full-blown speculative frenzy. What's really going on here is something called the debasement trade. And, it sounds complicated, but the idea is actually pretty simple. It's a quiet, creeping loss of faith in our regular currencies, the dollar, the euro, you name it. Investors are worried this money will lose its value over time, so they're fleeing to something they can actually hold, something tangible, like gold.
But here's where it gets really interesting. You've got to look at the difference between gold and silver right now. They're telling two completely different stories. Gold is being treated like a serious alternative currency. I mean, even the world's central banks are stocking up on it. But silver's price chart looks like a meme stock. It's pure retail euphoria, a speculative craze.
And look, this is a huge deal. As market analyst Francesco Caruso says, it's like we're watching the GameStop saga all over again. But this time, it's not a quirky video game retailer, it's a multi-trillion-dollar global asset. The kind of speculative fever we're seeing in silver is it's completely unprecedented. This is a classic case of what people call bubble psychology. And it's a crazy feedback loop, right? Rational people see the price and think, this is insane, I'm selling. But then the price keeps going up. And eventually, that fear of missing out gets so strong that they're forced to buy back in at even higher prices. And that just throws more fuel on the fire. In a market this irrational, a rational price target just doesn't exist.
Okay, so that's clue number one. Now let's switch gears and look at the bond market. The supposedly boring, sober part of the financial universe. Because it's telling a completely different and contradictory story. This is where things get really weird.
See, on one side of the ledger, you've got every single inflation alarm bell ringing like crazy. Precious metals are soaring, industrial metals are in a bull market, commodities are rising. Even the stocks of farming businesses are pointing to higher food prices ahead. The market is basically screaming that inflation is back and it's not going anywhere. But, and this is the absolute kicker, while all these assets are signaling inflation, the number one thing Wall Street expects is for central banks to cut interest rates. That's the exact opposite of what you're supposed to do. You fight inflation by raising rates, not cutting them. The two ideas just don't add up. This total disconnect has given rise to a group they're calling the bond vigilantes. These are investors who are basically saying, no way, we don't trust the central banks to get this right. They believe that anyone holding government bonds right now is at huge risk of getting wiped out by that inflation. As the saying goes, you're either at the table or you're on the menu. And these folks are convinced bond investors are about to be served up for lunch.
So let's recap. We have metals screaming inflation and the bond market betting on rate cuts. How on earth do you make sense of these completely conflicting signals? Well, there's a powerful metaphor that describes it perfectly. Caruso has this absolutely brilliant analogy. He says the market right now is like an M.C. Escher painting. You know the ones? At first glance, it looks like a normal picture of stairs and archways. But the longer you stare at it, you realize it's impossible. The stairs are going up and down at the same time. The whole structure makes no logical sense. And that painting, well, it perfectly captures the problem we're seeing right now. Stocks are at all-time highs, but the economy is just kind of meh. Gold is soaring right alongside stocks, breaking a 50-year pattern. Bonds are struggling, showing this deep distrust in the system. And regular people? Consumer confidence is low, which doesn't match these sky-high asset prices at all. Each piece looks okay on its own, but when you put them all together, you get a beautiful but completely impossible structure.
So, you have this beautiful, impossible structure. What could possibly make it all come crashing down? Well, there's one piece of this puzzle that's been eerily quiet, like an unlit fuse just sitting in the corner of the room.
And that fuse is oil. Think about it. Pretty much every other commodity has been on a tear, but oil prices have been held down, almost artificially. It's been a key tool for politicians and central bankers to keep the main inflation number from looking too scary. But that can't last forever. So here's the chain reaction you need to watch for. It's a domino effect, really. First, the spark. Oil prices start to climb and stay there. Then, the fire. That forces overall inflation to speed up again, which will spook the markets. Then comes the response. Central banks are backed into a corner and forced to slam on the brakes with aggressive rate hikes. And finally, the break. That sudden shock could be what causes this fragile, over-leveraged Escher painting to shatter.
Okay, so we've got this beautiful, fragile, and frankly, kind of terrifying picture of the market. The big question is, what does this all mean for you? How do you even begin to navigate this thing? And the honest answer, and it's maybe not the one you want to hear, is that right now, there are no easy, safe bets left on the table. The simple, unsettling truth is that nearly every asset class is already priced for perfection. They've all factored in a future where everything goes right. And you can see this in the hard data. Take a look at this number, 3.2%. According to Bank of America, that is the amount of cash that investment funds are holding. It's a historic low. That means almost everybody is all in. There's no cash sitting on the sidelines waiting to jump in and push prices higher. Everyone's already at the party.
You know, all of this points to what is probably the single biggest danger for any of us in a market like this. It's called recency bias. It's that natural human instinct to assume that whatever's been happening for the last few years is just going to keep happening forever. But all the signs we've looked at today suggest we are not in a normal time. The old rules might not apply anymore. So, here's the bottom line. What we're living through right now in the markets isn't normal. It's a total exception to the rules. And when you see everything flying this high in this beautiful but completely illogical formation, you have to realize that a sharp return to Earth isn't just possible, it's pretty much inevitable. The only real question left is, what's going to light that fuse?